Welcome back. Let's now talk about the CNBC TV 18 top 10 list of stocks for the day, and our entire team is here. And let's start with the big boy, Axis Bank. Abhishek is here to tell us more about how the quarter looked. Abhishek.
Well, Rima, it's better than expectations on many fronts. So if you take a look, the watch list, that's declined to 0.65% of the loans, perhaps at a 7-year or 28-quarter low. So deposits are up 15.24% YOY and about 11.65% sequentially. Advances are up 19.5% YOY and about 10.9% sequentially. Both these numbers do have the Citibank's India's retail consumer business numbers as well. Net interest margin came in at 4.22%. Phillip Capital was expecting it at 4.16%, so the net interest margin decline is much better than analyst expectation or lower than analyst expectation to say. Provisions were at close to 12,800 crore. This includes one-off provision that they have made for Citi's acquisition that they did in March, which is about 12,400 to 12,500 crore. Asset quality, the total slippages came in at about 3,375 crore. Analysts were working with a number of 4,000 crore, so much better over there. Annualized slippage ratio is at 10-quarter low of 1.6%. Asset quality is also good, given the fact that gross NPA ratio is at 2%, which is at a 28-quarter low. Net NPA ratio is less than 0.4%, perhaps at a 31-quarter low. So in terms of their performance, the NI is slightly below our poll. However, the loss is in line with our poll. Back to you.
Okay, all right, Abhishek. Thanks a lot for that. So going a little bit of green on Axis Bank. But Rima, the big tech numbers, Wipro, the numbers looked weak, but the problem was the guidance, right?
Absolutely. So for Q4, the company has clocked in a revenue decline of 0.6%. But the problem is the next quarter's guidance, -3 to -1%. The street was anticipating a flat guidance, -1 to +1. So in that context, the guidance has been very dismal. But the silver lining is a very large buyback, 12,000 crore of a buyback, a tender buyback at a price of 445 rupees per share. Kotak says the value at the valuations of 15 times forward multiple FY25 EPS, the stock is not yet cheap enough to warrant a relook. The stock may hold up in the short term courtesy a buyback. So the numbers are weak, the buyback is good, but just want to put on the table that Wipro ADR actually ended with a gain of 4%. There you have it. We caught up with the management of Wipro earlier today to talk more about the outlook, what went into this dismal guidance that they've given it for the next quarter. Listen in to what they had to say.
In some sectors, in some industries, certainly banking, financial services, also the technology sector, where what we're observing is that there is a certain reduction, slowdown of the discretionary spend. And that is, definitely generating a little more of uncertainty on our top line for quarter one. Not one single project got cancelled, not a single project, there's I would say there is not one event that would have any material importance to the guidance for Q1. We haven't seen any cancellation of deals. We haven't seen any delay in the ramp up. What we are seeing is, some of the deals, discretionary spend, if you like, is being either slowed down or spread. And so we are seeing a reduction of this discretionary spend in our accounts.
As I look at next couple of quarters, as you can imagine, our priority is really revenues and how do we convert the deal wins into revenues, how we get to a strong growth trajectory, steady state growth trajectory back. And hence our commentary is that we will try and maintain margins around the range that we have delivered in recent quarters.
We have not reduced anybody's salary. We had spent time in investing in people who were freshers and trained them. And at that point of time, we gave a choice to these freshers that those jobs were not available open immediately, but there are certain other jobs which are open immediate right now at a lower salary. And the choice is yours. You can continue with your existing offer and wait till we onboard you, or you can choose to come and join us at this role which is required now. And you'll be surprised that 92% of the people chose to join immediately. So I don't think so. It's a wrong interpretation that we have reduced anybody's salary.
Okay, well, that is Wipro, and in line with subdued earnings, we had numbers from Tech Mahindra and LTIMindtree as well, which came through. Reema, tell us more.
Well, for Tech Mahindra, the miss is on margin. So the top line revenue growth has come in at 0.3%, largely in line with street expectations. But the margins have disappointed. EBIT margins have come in at 11.2%, lower than the 12% that they clocked in the prior quarter. And plus, there is an impairment charge of more than 200 crore rupees. If you add that to the bottom line has fallen by nearly 14%. So there is a margin miss, which is hurting. And secondly, the deal wins have been holding in a band of above $700 million for the last many quarters. But this time, deal wins have fallen by 26% quarter on quarter and 41% year on year. And now it's below that run rate of $700 million to $1 billion. LTIMindtree, the growth has disappointed the street. LTIMindtree's growth at 0.7% is lower than consensus expectations of 2%. And if you compare it with the rest of the mid-cap IT companies, you would see the growth rate is actually significantly lower. But bear in mind that LTIMindtree is much larger than other companies like a Persistent or a Coforge, almost 4.5 times the size. But the growth rate is slightly on the lower side. That said, in the conference call yesterday, they have guided for double-digit growth. So that's fairly aggressive. So the street is going to be watching whether they will be able to achieve it. In fact, we will be joined by the management of Tech Mahindra, MD and CEO CP Gurnani, CFO Rohit Anand at 8:35 a.m. to discuss the Q4 outlook, the outlook on the margins and the way forward.
Okay, all right. Well, let's get back to a couple of other earnings. And Abhishek's still with us to tell us about Shriram Finance. Abhishek, those numbers a little bit disappointing?
Well, it was a soft number in terms of the P&L performance that they saw. Business momentum remained healthy. So disbursements grew by 6.2% quarter on quarter. Q4 is seasonally a strong quarter, and despite that, the single-digit growth on a sequential basis does not augur too well. However, let's take it on stride. AUM growth is at 4.5% quarter on quarter. Asset quality has seen marginal improvement. 8 basis point decline seen in gross NPA ratio. The net interest income growth is just 0.4% quarter on quarter. OPEX, that also increased by almost 21.2% sequentially. Now, they had amortized 300 crore of expenses at one go. Going ahead, they'll amortize 75 crore per quarter in their OPEX. Provisions, that increased by almost 29% quarter on quarter. That was largely to do with the fact that over there also there is a one-off expense of 294 crores, which they made provisions on the book as per their own clarification and as per the external audit that they had done over there. Net interest margin remains stable. However, PAT is down 26.4% quarter on quarter. So you can expect a weak opening in trade today for Shriram Finance. Back to you.
Okay, and we'll put some of those questions to Umesh Revankar, the Vice Chairman and Managing Director of Shriram Finance, who will join in to talk about the numbers at 9:40 this morning. Join in for that conversation. Indian Hotels is next up. Surabhi is here with details. Surabhi, morning.
Indian Hotels Q4 numbers were a positive surprise. They were a beat on all parameters, and they ended FY23 on a very strong note. The revenue was up 86% on a year-on-year basis, came in at 1635 crores. The EBITDA was up 3.3 times when compared to last year and close to 6% above estimates. Margins came in at 33%, 100 basis points higher than Motilal Oswal expectations, and PAT was close to 23% above estimates. They have seen sequential improvement in their average room revenue as well, close to 8% higher when you compare it to their Q3 levels, and the occupancy was the same as Q3 at 71%.
Okay, the number which is telling is the average room rent. Quarter on quarter, it's gone up by 7.5%. The number was 10,700 approximately in Q3, which is anyway a seasonally strong quarter, and it's now gone up to 11,500 crore. And in Q1, which is anyway a strong season because of summer holidays. Let's see what that number looks like. That's the average room rate, ARR. But let's talk about PI Industries, 2 large acquisitions done by the company to enter in the pharma space. Ekta's here with the details. Ekta.
Thanks for that. Well, yes, PI Industries will be in focus because they made 2 acquisitions, which is going to finally help them enter into the pharmaceutical space. The funding will be via the cash as well as the QIP proceeds that the company has. So they will be acquiring Therma Chem Research Medilab for around $50 million, and there will be an additional $25 million possible payout in performance-linked payouts over the next 6 years, with particular to this company. It provides services in the preclinical and clinical stages. Consolidated revenue is 33 million for FY22, normalized EBITDA 14 million. The other acquisition is an Italy-based company for 34 million euros. It is a small API manufacturer plus CDMO. Revenue $45 million, EBITDA 7 million as of CY22. The overall impact is that the company is looking to build a differentiated CDMO offering across the pharma value chain. Remember, they have tried to make a foray earlier. In 2021, they had the InSwift Lab acquisition, which didn't really go through, and hence the street is now looking for this particular acquisition as a positive, as it will address growth concerns. It is going to be earnings accretive. The valuation seems reasonable at this point in time. Hence, you can expect the stock to probably be in the green.
All right, Ekta, thanks very much for that. PI Industries, some acquisitions, and hopefully we'll have the management with us a little later. Well, let's get back to Surabhi. She's got details on Godrej Consumer and Raymond. The deal was announced yesterday post-market hours. Surabhi, over to you.
That's right. So CNBC TV18 Newsbreak has now confirmed that Godrej Consumer is going to buy Raymond's FMCG business in an all-cash deal for 28-25 crores. Now, this business is being sold to GCPL along with trademarks of Park Avenue, KS and Kama Sutra. Nuvama says that 80% of Raymond's FMCG business comes from deodorants and 20% comes from sexual wellness, with gross margins of 50% and EBITDA margins of 6%. Raymond's consumer business has done 411 crores of revenue in FY21 and scaled it up to 622 crores of revenue in FY23. Now, the view on the street is that this acquisition is slightly expensive at 4.4 times sales and 73 times EBITDA. Just to give perspective, Emami is currently trading at 5 times EV by sales. Now, the deodorant space has historically been very competitive, and that's visible in Raymond's weaker EBITDA margins as well, so that's an added concern. We'll have to watch out for how Godrej Consumer's distribution can scale up the business and deliver growth in an under-penetrated segment of deodorants and sexual wellness.
Thank you very much for that, Surabhi. In fact, my colleague Yash Jain asked the management of Raymond about the rationale behind the valuation. Listen in.
At the Raymond Group, we believe very strongly in managing and nurturing our business. And in our demonstrated performance, every single business, we have demonstrated growth, margin improvement, and that reflects in the value creation of our business.
Would you say it's a good deal for Godrej Consumer or a good deal for you?
Nobody does a deal if it's not good for it. Okay? You must look at a win-win. 100 rupees in your hand has a different value than 100 rupees in my hand. Should I have got 300 crores more? Yes, I could have got 300 crores more. But by getting 300 crores less and getting the deal done, see what I will achieve on the demerger. If I get that done, I won't make 300, I'll make 500 crores more. From their point of view, you might think they've overpaid, but they are smart business people. They know what the potential is. Sometimes you don't pay for the product, you pay for the potential. And if they just take it and plug it into their system, they have a growth plan. And, you know, they're very smart people. They've done extremely well. I know them extremely well. So I think this is genuinely one of, and I passionately say it, genuinely a fantastic win-win deal.
Okay, Raymond believes it's a very good deal even for GCPL, though analysts are not convinced about the high valuation paid of 4.5 times EV to sale and the fact that the acquired company has EBIT margins of just 6.5%. So very low in terms of EBIT margins, and this is a very highly competitive space. Let's quickly recap then some of the top stocks. Stocks with positive news flow are Axis Bank, Indian Hotels, PI Industries, Raymond, while stocks with negative news flow are the tech companies, Wipro, Tech Mahindra, LTI Mindtree, Shriram Finance and Godrej Consumer. And in a bit, we'll also talk about ECC. But as before that, let's